Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. As always, I'm excited to be here with all of you. Today, it is episode 129 of Your Tax-Free Life podcast, and the name of this episode today is Things to Know About Roth Conversions. Things to know about Roth conversions. So a week doesn't go by that I don't get one or two calls from either clients or from someone in my online community asking me a number of questions regarding Roth conversions, Roth contributions, the advantages, the disadvantages, and so forth. So although I have done a number of podcasts dealing with Roth and the benefits of Roth, I want to take a few minutes of your time today and kind of cover some of the things that are important for you to look at as you start to prepare and or considering making a Roth conversion at some point in time in the future. Now, one of the first things you got to consider is, what is the conversion cost? How much is it going to cost you to convert a portion of your retirement assets that are traditional in nature, like a traditional 401k, IRA, 403b, to a Roth IRA? And what is the cost to that? As you know, whenever you do any type of conversion from a traditional retirement account to a non-traditional retirement account or a Roth, then you have to pay taxes in the year or for the year that you're making that conversion. So the question is, well, how much is it going to cost? Well, that depends. It depends on your ability to be able to pay the tax. Many times whenever I get a call from a client or a potential client or someone on my online community, I go ahead and I do a tax plan to determine what would be the optimum amount of the conversion or over a given number of years. Remember that under the current tax law, we have until December 31st of 2025. So we have a 6-year window in which to do as many conversions as you possibly can, because at the end of the day, when we all wake up January 1 of 2026, taxes are going to be higher than they are today. The other question is, in thinking about a conversion, is, what are the future tax liabilities? Where do you think that taxes are going to be in the future? Do you think they're going to be higher? Do you think they're going to be lower? Or do you think they're going to be remaining the same? And when you look at the future tax liability through a telescope as opposed to a microscope, then you can start to see that there's going to be a very high probability that taxes are no longer going to be higher in the future. They're going to have to be much, much higher in order to pay for the financial mess that we find ourselves in the United States of America. Now, the other question is, well, what is your personal tax liability and what is it going to look like in the future? Now, most of you think you're going to be in a lower tax bracket when you retire, but that's not going to be necessarily the case. I would argue that the only time you're going to be in a lower tax bracket when you retire is if you're a financial failure in life, because when you retire, a number of the deductions, exemptions, and credits that you were taking while you were working, you're now going to lose. So therefore, even if taxes were not to go up in the future, your personal tax liabilities may go up because of the fact that you're not going to be able to deduct some of the things that you were deducting before. What am I talking about? Well, children, because they're a deduction, they're a credit. Mortgage interest that you were able to take a deduction on every year. Contributions to your qualified plans, if you were maxing out on your 401k, or you were maxing out on your IRA, you were taking a deduction that year. But then when you retire, you're no longer employed. So therefore, you're not going to be able to take any of those deductions. And there are others there as well that you need to consider. Another question is, well, where are you going to live in retirement? Let's say that you live in a state that there's no state income tax, and all of a sudden you have your children that move to a state, or they live in a state that does have an income tax, a state income tax, and you want to be closer to them. What's going to be your tax liability, because now it's not only federal income taxes, but state income taxes on those distributions from your retirement accounts. Another big question is, well, how large is your qualified plan today? How much money have you made in contributions over the years? Where have your retirement accounts grown to? And remember, when you put money into a qualified plan like an IRA, 401k, or 403b, or some other pension plan, you're not saving any money on taxes. All you're doing is you're postponing the tax. And when you postpone the tax, you're also postponing the tax liability. So understanding what is the value of your qualified accounts today, and then do a fast-forward rate of return calculation as to figure out what could be the growth on these accounts over the next few years up until the time that you need to start taking distribution. And those are things that are very, very critical, because at that point in time is when you start taking distributions and figure out what your tax liability will be. And then once you get into your RMD years, which are your required minimum distribution years, for some of you may be 70 and a half, for others may be 72, then you're not going to have a choice. And depending on the value of your account, the IRS is going to dictate how much you have to take every year, whether you need the money or not. And if you don't take that money, not only are you going to have to pay taxes on the money that you should have taken but you didn't, but you're also going to have to pay a 50% excise tax liability as a penalty for not taking the money when you had to. So those are things that you also need to keep an eye on as you move forward into the future. Also remember that your RMDs, your required minimum distributions in retirement, they're going to have a tremendous impact on your Social Security benefits, your Medicare premium, and so forth. And then for those of you that are going to have a very nice and sizable retirement, you also have to consider the impact of the 3.8% Medicare surtax, which is assessed on your adjustable gross income from a business standpoint. So if you're married filing jointly and your annual retirement income is going to exceed $250,000, then a 3.8 Medicare surtax is going to be added on to your modified adjustable gross income. And if you happen to be single, it would be anything north of $200,000. So there are many of you that are going to be generating a lot of money in retirement, and good for you, but you got to be careful, because now you're going to have to pay a higher surtax, and those liabilities are going to cost you. And if you don't pay attention to tax planning, and if you don't do any type of tax planning for your retirement assets, then you may find yourself running out of money before you run out of life, because at the end of the day, you live on the net. So that means that if more and more of your distributions are going to go to taxes and inflation, then you may have no choice but to pull more and more money in order to maintain your standard of living. And by doing so, you're accelerating the depletion of your retirement assets a lot sooner than you expected. Another question is, well, are you going to leave any of your money to other family members? And does it make sense to leave it as a traditional account or as a Roth account? I would argue that leaving money as a Roth is always better because of the flexibility and the tax-free approach and growth of that money inside of those accounts. Another big question that I ask my clients as they start to consider Roth conversions is, do they have any company stock inside of their qualified retirement plan? And there's something known, actually it's not very well known. Most tax practitioners should know it, but not everyone does, is something called NUA, which is net unrealized appreciation. And that is when you have actually company stock inside of your qualified plan. So it allows for capital gains growth of the stock since you bought it out of the qualified plan. So if you're going to take distributions out of a qualified plan that has some company stock, you may be better off taking that company stock out of that qualified plan. Obviously, you're going to have to pay taxes up to the cost basis, but then any growth on those on those stocks, company stocks, are going to grow on a tax-deferred basis, and then when you finally liquidate that stock and pay taxes, it will be based on capital gains rate as opposed to ordinary income tax rates. So therefore, you're going to be able to save a bundle in taxes from a business perspective. Now, I want to talk a little bit about penalty-free distributions from Roth IRAs, and that's something that many times I get asked questions about. And the rules are convoluted, just like any area of the IRS code, and they're north of 77,000 pages in the IRS code. If you do one thing on one side of the ledger, it could have a negative impact on the other. So you really need to understand, all of the rules of engagement when it comes to tax and penalty-free distributions from Roth IRAs. One of them is called the 5-year rule. And the 5-year rule only applies if you are under the age of 59 and a half, which means that if let's say you're 57 years of age and you want to take a portion of your traditional IRAs or your Roth or your traditional 401k and you want to convert that to a Roth, you can do that conversion and avoid the 10% penalty and obviously be able to do that without any problem whatsoever. But the challenge is that if you're not 59 and a half and you're not careful, then there may be some liabilities along those lines. And the second part of the 5-year rule applies to the tax-free earnings. So if you're 57 years of age, and I'll give you an example in the next few minutes, and you do a Roth conversion, you should think of yourself that you're not going to touch that money for 5 years. So between the ages of 57 years of age and 62 years of age, you're not going to touch that money. As a point of reference, even if you do that conversion, let's say in December of 2020, the date of the conversion for tax purposes and for the 5-year rule goes back to January 1st of 2020. So you can actually wait till the very end of the year, do a conversion, and you have actually gained almost a year. You've gained 11 months because of the fact that it'll be retroactive as an accounting standpoint to January 1 of 2020 as opposed to December of 2020. Now, the second 5-year rule applies to tax-free earnings. What does that mean? Well, it means that the holding period starts when the first Roth IRA is created, and the holding period begins on January 1st of the year of contribution, as I stated earlier. For some of you, you may find yourself in a position where you may have opened an IRA, back when you were in your early 40s, and then you had that IRA for a while, then you closed it a few years later, and then you pull the money out and whatever. Well, you can still count that first Roth IRA that you used in order to offset the 5-year rule along those lines. So let me give you now, again, that's all convoluted. Make sure that if you have any further questions that you can reach out to me or reach out to your tax practitioner, because it's important that you get a feel for what's truly going on when it comes to Roth conversions. But let me give you an example, and this is something that you may want to kind of walk through, and then if you have any questions, obviously call me at your convenience. But let's say that Mary established her first Roth IRA with a conversion in 2019 when she was 57 years of age. Now, she must wait until the 5-year holding period ends on January 1st of 2024, right? Because that was 2019, so to 2024, that would be 5 years. And until she's 59 and a half for the distribution of her earnings to be tax-free and to make it a qualified distributions. Now, both qualifications must be met. Now, Mary can always, at the age of 59 and a half, she can always pull the money that that she contributed, because obviously she has already paid taxes on that money and there would not be any penalty along those lines. But if she wants to be able to pull the money and also the growth of that money, then both of the rules would need to apply. She would have to wait for the 59.5 rule and then the 5-year period in order to be able to maximize that distribution. The second part of that would be at age 59.5. Mary could withdraw the entire account penalty-free. However, any earnings would be taxable as she has not met the 5-year holding period. So this is just giving you a recap on the previous point that I made to you, that at age 59.5, she would have the ability to withdraw the entire account penalty-free, but any growth in that account would be taxable because of not meeting the 5-year rule. And then the last point is that since Mary was 57 when she established her first Roth IRA, she must wait the 5 years to earn the benefit of tax-free earnings. In other words, in order for her to avoid taxes on the earnings, she would have to wait the 5 years. However, there would be no 10% penalty on the earnings because Mary was 59.5 or would be 59.5 when the funds were withdrawn from her account. So as you can tell, there are quite a few challenges and there are quite a few rules when it comes to Roth conversion and Roth contributions and then Roth withdrawals. Now, I didn't go a lot into Roth contributions because that would be a conversation for another day, but I thought that this would be something important for all of us because I keep getting questions on these issues often, and many financial advisors don't have the idea, or they're convoluted as to how they think about how Roth accounts work from a business standpoint. So for those of you that may want to reach out to me, please feel free to call me. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always, always, always remember that my goal for you, your family, and your business is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you so much for giving me a few minutes of your time, and I'll talk to you again next week. Take care. Bye-bye.